The Sensex has hit 65,500, well past its previous peak. So we are now at an all-time high. So is the Nifty at 19,500 or thereabouts. Now, both these indices reflect the newfound exuberance in the Indian stock market. You can say a variety of things. It could be a China factor. There is no alternative to India in terms of economic growth currently. The problems of the Western world, so many factors can involve. But the fact of the matter is that the stock markets are at an all-time high. Now, as an investor, some of the common questions that we have is, should we wait for corrections before we invest this money? Should we postpone our investing journey going forward? Is this a good time to continue one's investment in SIPs? And should one kind of book profits and stay away from stock markets? These are all the questions that we're going to answer in today's episode. First up, let's deconstruct the stock market indices for you. At 65,500, the index of BSE sensitive 30 top stocks discounts the market by about 24 times. What it means is, at this level, the earnings per share of the index discounts the market by about 24 times, which means that if the markets were at the same level in 24 years, you will recover your investments. But that's hardly the way markets work. So 24 times price earnings multiple does seem a little expensive given the context that the rest of the world is really kind of going through their own pains. But the fact of the matter is that India's economic journey is on a reasonably sound footing. And therefore, there is no reason to believe that the earnings, which are currently close to 2,000, won't get better as we go along the way. Same is the case with Nifty. Now, our assumption of giving this is that the economic growth in India is growing at about 6.5%. Now, add a factor of 5% towards inflation, which means the real nominal growth rate works out to about 11.5% of the economy at large. Now, if you are among the top 30 or the 50 companies, it's understood that you will be growing at higher than that. So, which is why we have attempted to calculate the EPS growth rate at 15%. Now, if the EPS growth rate is considered to grow over the next 5 years at 15%, and if the market discounting, that is the price earnings multiple that the market assigns, is the same as what it is today, then in the next 5 years, you're actually looking at doubling of the index values. So what is 19,500 is going to become 38,000. And what is 65,000 is going to nearly double as well. So my ask is, given the fact that we are in a good place and the market is growing and the next 5 years appears to be reasonably good, investors who have that kind of a horizon and more must continue to stay invested. You should continue your SIPs if you're already doing that. It's a great time to continue your SIPs. But if you're bringing in lump sum investment now, we are advising you to stagger it. It's not a good idea to put all your money at one go. Stagger it over the next, say, 12 months or so that you get an average in your entry journey. The stock market will also undergo a reasonable amount of corrections along the way. It's unlikely to stay the way it is and grow in a very linear manner. It never happens that way in stock markets. There will be some bad news along the way which will ensure that the stock market corrects by about 5% from these levels or thereabouts. If it does happen, do not panic. Just continue to stay invested because, as I said, As long as India's fundamental growth story continues to remain intact, we should see the index values double of where we are in the next 5-6 years' time. So that's a very, very exciting news for every stock market investor. Remember, the foreign institutional investor is not doing us a favor by bringing in money. He is actually believing that he can make much more money investing in Indian stock markets than in his own home, which is why he is bringing so much of money. Why then must he be the only man who makes his money? We should invest in our own stocks. So stocks or mutual fund, take your pick. Look at a 5-year horizon, invest in fundamentally sound mutual funds or stocks, and I'm sure you will have a fantastic journey of doubling. Don't get worried about short-term losses if there are due to fluctuations in the market. As long as you don't sell, it is not a loss. So to that extent, we believe that these are great times to continue to stay invested.